Global stocks have suffered their worst week since the financial crisis of 2008, amid fears that the coronavirus could reach possible pandemic status, with more than 83,000 people across 50 countries now infected and more than 3,000 dead. The Dow fell almost 1,200 points on Thursday, its largest single-day fall in history, to drop into correction territory as it also headed for its worst week since the crisis. The S&P 500 and the Nasdaq also both fell into correction territory from record highs only 1 week ago. The MSCI barometer of stocks in developed and emerging markets has fallen by more than 10% over the last week, with travel and leisure stocks in Europe particularly hard hit, suffering their biggest fall since the terrorist attacks of 9/11. In the UK, the FTSE 100 has fallen more than 3%. Asian markets at the centre of the epidemic are continuing to fall, with investors worried that the coronavirus could spark a global recession. What was even just a week ago generally seen as a China issue has rapidly developed into a global issue. Investors around the world are moving into safe haven assets, most notably government bonds. Moving inversely to price, the yields on the US 10-year Treasury note and the 30-year Treasury bond have fallen to all-time lows, with the yields on German bunds and UK gilts also falling. Deutsche Bank estimates that the market fall has caused the equivalent of a 0.12 percentage point increase in the Federal Reserve's main interest rate, commenting, "Over the past few days, financial conditions have tightened sharply in response to rising fears that the coronavirus could exert a more severe and persistent drag on global and US growth than previously expected." The VIX index, a closely watched measure of expected volatility in Wall Street stocks, hit 47, a threefold rise over the last week as traders moved to hedge against further fallout from COVID-19. Bank of America are predicting that global growth will slow in 2020 to below 3%, the weakest pace since the financial crisis. Goldman Sachs are predicting that US corporate profits could also stagnate this year, cutting their previous earnings growth expectations. The corporate fallout is already worsening around the world. Dozens of companies have warned of disruptions to their supply chains, as well as a decline in consumer demand. Apple and Microsoft have both stated that their businesses will be affected. Shares in airlines have also been badly hit as travel bans are imposed and companies continue to cut back on staff travel. Corporate events are also in the line of fire. In Switzerland, a ban has been put on events attended by more than 1,000 people, resulting in the cancellation of Geneva's annual motor show. The Mobile World Congress in Barcelona has also been cancelled, with the Chinese Grand Prix postponed. Brent crude prices have also fallen almost 3% to below $51 a barrel, while West Texas Intermediate, the US marker, fell 3% to around $45.70 a barrel, the lowest level in over a year. Markets will now be looking to the Fed to cut rates in an attempt to counter any further impact, a strategy that not many other central banks will be able to adopt, given that their rates are already so low.